Welcome students. In this video we are making an attempt to learn computation of taxable income and tax liability with respect to individual assessees. And our discussions mainly will be considered for syllabus purpose and for the university exam related content. This is the format for calculating total income and tax liability of an individual assessee. We are mainly concerned with assessment of an individual. As we have already understood, there are 5 heads of incomes. 2 heads we have learned in the 5th semester BCom level, and the remaining 3 heads we have learned during this semester. So we have to take income from salary, income from house property, taxable income from business and profession, taxable income from capital gains. But while taking capital gains, we have to exclude long-term capital gains and short-term capital gains where STT is attracted. So except these two, STCG with STT and LTCG. Except these two, any other capital gains we have to add. And then finally, taxable income from other sources. Even here, we have to exclude casual income. Casual income is nothing but winning from lotteries, card games, TV show games, horse races, betting, gambling. All this comes under casual income. So except these, we have to add all 5 heads of incomes, and which is called as gross total income. From this gross total income, we have to give deductions under section 80C to 80U. Then we will arrive at the total taxable income. But this will be excluding the 3 which we have excluded in previously. Now we have to add it back. Casual income, long-term capital gain, short-term capital gain with STT, and any other deemed incomes if it is there, all that we have to add it back to the income to arrive at the total taxable income, or which is also called as net income. But we have to remember these, why the 3 points or 3 items is excluded in gross total income. The reason is all these 3 items attracts a flat rate of tax. There is 2 types of taxes. One is flat rate and another one is slab rate. Flat rate means whatever the income you get under the flat rate system, it will be charged at a flat rate of 10%, 20% or 30%, whatever is fixed. Whereas under slab rate, which applies to individual income, individual assessees, like up to 2.5 lakhs there is no tax, 2.5 lakhs to 5 lakhs there is 5%, 5 to 10 lakhs 20%, 10 lakhs and above 30%. This is called as slab rate. That is the difference between the slab rate and the flat rate. So after applying this format, we will arrive at the total taxable income. And then let's look at the format for calculating tax liability. As I explained you earlier, these 3 items, casual income, LTCG, STCG with STT, will attract a flat rate. That's why casual income is at 30%, it is taxable. LTCG is taxable at 20% and STCG with STT is taxable at 15%. There is one more, deemed incomes. Like if there are any unexplained expenditures or cash credit or investments or money where you are not able to explain the source, such items is also taxable at a flat rate of 30%. And after all these, finally whatever is the left out income, and that income is taxable under slab rates. That's why it is given in the bracket. You can identify the difference between the slab rate and the flat rate. Now the total of all these 5 put together is your total tax. If your total income is is less than 3,550,000 per annum, then you are eligible to claim a rebate under Section 87A for rupees 2,500 or 100% of your total tax liability, whichever is less. After subtracting the rebate, if you are eligible, whatever the total tax we get, to that total tax we have to add surcharge if it is applicable. Surcharge of 10% of income tax where the total income exceeds 50 lakhs per annum. If the income exceeds 1 crore, then the surcharge will be charged at 15%, 15%. So that we have to add. Health and education cess at 3% we have to add. So now we get the total tax. From this total tax, if you have paid any advance taxes or tax deducted at source, that has to be subtracted. If you are supposed to pay any interest or penalty for your delayed payment or any other legal proceedings against the assessee, such interest and penalty has to be added. And finally, we will arrive at the tax payable. Sometimes this tax payable or tax liability, what we normally call, it can be even a negative value, which means that refund that you have to receive from the tax authority. It is not always the tax is payable by the assessee. Even whenever you have paid excess tax in the form of tax deducted at source, so for example, you have banking investments or you have interest from bank, where the bank would have already deducted the TDS at the source itself. So all such TDS, if you are not coming in the tax bracket, you can claim that refund back from the tax authority. So that is the reason why everybody, even if I'm not supposed to pay tax, but still it is good to apply or file income tax returns. That is the best practice. So it can be tax payable by the assessee to the tax authority, or if it is a negative value, which means that this is the tax refund which has to be paid by the tax authority to the individuals. This is how the format will be followed. Please understand it properly. I was mentioning about the flat rate of tax and slab rate of tax. Now you look at the slab rate of tax for different individuals based on their age. It is based on the different types of persons. Individuals, HUF, association of persons or body of individuals, and artificial persons. These are the slab rates which will be applicable. If your net income is ranging between up to 2.5 lakhs, there is no tax. 2.5 lakhs to 5 lakhs, 5%. 5 to 10 lakhs, 20%. 10 lakhs and above, it is 30%. Same way, for the senior citizens, those who are above the age of 60 years but less than 80 years of age, for them up to 3 lakhs there is no tax. 3 lakh to 5 lakh means the 2 lakhs difference amount, 5% they have to pay. How we calculate normally? 3 to 5 lakhs means 2 lakhs. 5% of 2 lakhs we have to take. Then 5 lakhs to 10 lakhs, 20%, 10 and above it is 30%. There is a third category of citizens who are called as super senior citizens whose age is above 80 years. So for them, up to 5 lakhs there is no tax. 5 to 10 lakhs, 20%, 10 and above it is 30%. I was mentioning about 87A rebate. Any resident individual whose income is up to 3,50,000 per annum can avail this rebate. It is a deduction from the income tax before calculating the education cess, higher education cess. and the amount of rebate is 100% of the income tax that we have to pay, or rupees 2,500, whichever is less. And surcharge is nothing but it is also called as tax on tax. 10% of your income tax if your total income exceeds 50 lakhs. 15% of your total tax if your income exceeds 1 crore. And health and education cess is at 4%. These are the basic concepts, information which you people should be aware before calculating the problems. Here is a small illustration to understand how to calculate tax liability of an individual assessee. There are 3 assessees given: Mr. Amar Gupta, whose income is 3,40,000, Mrs. Jyoti Gupta, 5,20,000, and Mr. Animesh Dash, 6 lakhs. He is senior citizen. It is very clearly given. So we have to apply the slab rates and find out what are their tax liability in each of the 3 assessees case. The first one, Mr. Amar Gupta, his total income is 3,40,000. So he comes under the first sector. So up to 2,50,000 there is no tax, nil. 2,50,000 to 5 lakhs. But his total income is only 3,40,000. So the remaining difference, 3,40,000 minus 2,50,000, it comes to 90,000. So on this 90,000, 5% tax we have to charge. That comes to 4,500. So the total tax becomes 4,500. Now his income is less than 3,50,000 per annum. That means he is eligible for rebate under section 87A. So 2,500 rupees or 100% of total tax. Total tax is 4,500 or 2,500 rebate, whichever is less. So 2,500 obviously is less, so that will be subtracted. So now your total tax liability becomes your 2,000. After giving the rebate, now you have to add 4% of education cess. 4% of what? 4% of rupees 2,000. That comes to 80 rupees. So now your total tax payable is 2,080 rupees. I hope you people have understood in the first case how we have calculated the tax liability. Look at the second case, Mrs. Jyoti Gupta. Her income is 5,20,000. So up to 2,50,000 there is no tax. The second slab comes to 2,50,000 to 5 lakhs. That means the difference of 2,50,000. On this 2,50,000, 5% is the tax rate. So 5% of 2,50,000, 12,500. And the remaining amount. So already you have subtracted till 5 lakhs from your total income. Now how much is left? 5,20,000 is your total income minus 5 lakhs. Up to 5 lakhs you have already charged 5%. So the remaining difference amount is 20,000. On this 20,000 you have to charge 20%. That comes to 4,000. So your total tax becomes 16,500. Now she is not eligible for rebate under section 87A because her income is more than 3,50,000 per annum. So straight away we are not giving her any rebate. Straight away we are going to charge education cess 4%. 4% on 16,500, it comes to 660. Now when we add these two, the total becomes 17,160 rupees is your tax payability. Look at the third situation. Senior citizen, up to 5 lakh rupees, the tax will be charged at a minimum rate. His income is 6 lakhs. Up to 3 lakh rupees, there is no tax. So 3 lakh to 5 lakhs, there is a difference of 2 lakh rupees. On this 2 lakhs, 5% charge means 10,000. Now out of his total income 6 lakhs, up to 5 lakhs you have already charged. Now the remaining, how much is left? Only 1 lakh is left. So on that 1 lakh, 20% we have to charge. So 20% comes to 20,000. So total it becomes 30,000. And his income is more than 3.5 lakhs per annum. So the senior citizen is also not eligible to claim rebate. So straight away we charge education cess at 4%. 4% of 30,000 comes to 1,200. So your total tax payability is 31,200. So depending on your total income and your age, you are going to apply the slab rates and find out what is the total tax payable by the assessee, or it can be a refund also if it is a negative value. Hope you people have understood the tax liability concept. Let me explain you few illustrations basically covering the section deductions. This question is mainly for ATC. The entire question mainly it covers life insurance premium on his own life, wife's life, married daughter and dependent sister. Repayment of loan from LIC for purchase of commercial house property, contribution towards URPF, tuition fees of daughter, life insurance premium on the life of his major son which is due on 1/12/2018 or 3,000 but paid on 1/5/19. So how this tax treatment we will understand. Accrued interest on National Savings Certificate 5,000, contribution to PPF and Sukanya Samruddhi scheme. So let us understand how to solve this. Now under section 80C, the life insurance premium on his own life, wife's lives or dependent daughter or son can be considered, but not the dependent siblings. Brothers, sisters will not be considered. So life insurance premium on own life 2,700. Life insurance premium on wife's life 8,000 is taxable. That means he can claim for deductions. Life insurance premium on married daughter, whether the daughter is dependent on you, independent, or married or unmarried, but still you can claim as deduction. Life insurance premium on dependent sister's life cannot be claimed as deduction. Repayment of loan taken from LIC for purchase of commercial house property cannot be claimed as deduction under 80C. If it is any housing society like HDFC or any other housing schemes, interest is allowed as deduction but not the repayment of the principal amount. Contribution to URPF is exempted from tax. Tuition fees of 2 children can be claimed. Here the tuition fees of daughter is given 22,000, so entire amount is exempted. Means you can claim deduction. LIC insurance premium on his major son which was due in December 2018, but 3,000 was paid in May 2019. So May 2019 will fall in 2019-20 previous year. So it will not be applicable for 18-19 previous year. So we are not showing that as deduction. Accrued interest on National Savings Certificate is claimed as exemption. So you can claim for deduction. Contribution to PPF, you need not have to claim. It is already exempted from tax. A deposit in Sukanya Samruddhi Yojana, you can claim this as deduction. So after adding all these items, the total it comes to 49,700. So but the actual amount which is allowed is 49,700 is your actual investment, or rupees 1,50,000, whichever is less. So the less amount is 49,700. Your eligible to claim 49,700 as deduction under section 80C from your gross total income. Under this illustration, I am trying to explain the concept of ATC, ATCCC and ATCCD and put together a combination of all the three, how to do the tax treatment. Let us understand that. You should remember that we have to first calculate what is his total income. Total income and with the application of sections. It is given income from salary is 6 lakhs and income from other sources is 2 lakhs. So 6 plus 2, 8 lakhs becomes your gross total income. From this gross total income, we have to give deductions. Just remember, in the questions, nowhere it will be mentioned which point comes under which section. But in your solution, you have to clearly mention ATC, ATCCC, ATCCD, ATG or whatever section it comes. You have to clearly specify that. That is the reason why I am insisting you people to study all the sections individually and remember which one comes for what. So now deductions under ATC. Own contribution to PPF, Public Provident Fund, up to 2 lakh rupees. It is exempted from tax. You can claim it as deduction. So 2 lakh rupees or an amount of 1,50,000, whichever is less. So 1,50,000 becomes eligible for deduction. Under ATCCC, LIC annuity plan deposit notified under annuity plan of LIC rupees 5,000. So 5,000 or rupees 1,50,000, whichever is less. So 5,000 is claimed as exemption. Then you have contribution to NPS, National Pension Scheme. So under this NPS, it is already included in 1.5 lakhs, but additional 50,000 is given. So that means up to 2 lakh rupees you can claim. If there is NPS, you can claim additional 50,000 also as deduction. But here, the own contribution towards NPS is only 40,000. So he can straight away claim 40,000 additional deduction for under section 80CCD towards contribution to NPS. Whereas when it comes to all the three sections put together, ATC, ATCCC, ATCCD, total put together, again it should not cross 1,50,000. Maximum limit is 1,50,000. So total it comes to 1,50,000 plus 5,000, 1,55,000 or 1,50,000, whichever is less. So obviously 1,50,000 is less, plus 40,000, 1,90,000 you can claim as deduction out of 8 lakhs. So your total taxable income becomes 6,10,000. So please try to understand. Nowhere in the question it will be given which point comes under which section. It is only by practice what we have learnt. And remember to mention the sections properly. This question mainly concentrates on medical insurance and medical treatments and how to do the tax treatment. Just read the question thoroughly and let us understand how to do the tax treatment in this case. In this question, the assessee, that is Sudhir, has provided the details for the previous year 2018-19 and we are supposed to calculate what is his total income for the assessment year 1920. His business income is 8 lakhs and income from other sources is 80,000. So gross total income becomes 8,80,000. Out of this, there are the third point is medical insurance premium paid to GIC, General Insurance Company, on the life of his dependent father. His age is 87 years and 8,000 is a insurance premium. Medical insurance premium comes under 80D. So medical insurance premium 8,000. Maximum limit is 50,000. 25,000 for his family and 25,000 towards his parents, father and mother. So total put together 50,000 he can claim. Out of that, 8,000 is the insurance he is paying. So whichever is less, so 8,000 only he can claim as deduction. Then the fourth point in the question, expenditure incurred during the previous year on the medical treatment of his dependent grandmother being a person with disability. Remember, grandmother will not come under any of the exemptions list. You can claim for medical treatment of yourself, family, parents, but not the grandparents. So he is not eligible to claim deduction for his grandmother's treatment. Then expenditure incurred on medical treatment of dependent mother whose age is 65 years and is from a recognized hospital. 80,000 has been spent, but 70,000 has been received from the insurance company. This comes eligible under section 80DDB. So according to 80DDB, the assessee can claim up to 60,000 rupees for his dependent parents. 60,000 is the maximum limit he can claim, or 80,000 what he has spent for the treatment. But the insurance company has given you only 70,000. So whatever you have spent and your eligibility is only 60,000. So you can't claim more than 60, though you have received 70,000 from the insurance company. So your taxable exemption that you are eligible to claim exemption is only 0. You can't claim any exemption. Again, why? Because the insurance company has given you 70,000, but you are eligible to claim only up to 60,000 towards your mother treatment. Got it? So no exemption for this. Then expenditure incurred on medical treatment of a dependent sister. 80,000 has been spent, but from the insurance company you have received 30,000. So 80,000 is your amount spent. 40,000 is as per the income tax rules you are eligible to claim, and 30,000 is what you have received from the insurance company. Your eligibility is 40,000, but you have claimed 30. So the difference 10,000 still you can claim. So 10,000 becomes your eligibility for deduction. Then the last one, expenditure on medical treatment of who is suffering from a special disease of his brother. He is recognized in a treated in a recognized hospital. So 45,000 has been spent, and as per income tax rules you are eligible to claim 40,000 and 35,000 what you have received from the insurance company. So the difference is only 5,000 that you can claim for deductions. So put together 8,000 under 80D. Under 80DD, your grandmother's treatment will not be considered. Under 80DDB, you are eligible to claim 15,000. So after deducting the deductions, your total taxable income or net income comes to 8,57,000. Look at this question. Mr. Sumant, a resident, furnishes the following information, and we are supposed to find out what is his total taxable income or net income. He is giving us business income, long-term capital gains, short-term capital gains not covered by the section 111A. Not covered by under section 111A means there is no security transaction tax. That means this STCG can be added to gross total income. Suppose if it is reverse, like in the bracket if they give covered under section 111A, which means that this has to be excluded while adding gross total income, and we have to charge 15% flat rate on this amount. But here it is not covered under section 111A, so that means it is included in gross total income. No flat rate will be applied. Then he has some interest on debentures, income from other sources. It will be payment to medical insurance premium on own life will come under 80D deductions. Donations are given. Donations comes under 80G. So we are going to learn 80G and 80D in this question. Another important thing while reading the question you should give donations. You should remember there are three categories of donations. Group A 100% deductible, Group B 50% deductible, and Group C with limit. With limit under Group C, again we have two categories, 100% and 50%. So while reading the points, please make note of it. Donations to National Trust for Welfare of Persons with Autism will come under Group A 100%. Fund set up by Gujarat government is for 100% Group A. Donation to Rajiv Gandhi Foundation and Prime Minister's Drought Relief Fund is for Group B 50%. And approved public charitable institutions will be eligible for Group C, that is with limit. So whenever you classify these points, be little careful while calculating adjusted taxable income. Now let us solve this question. His total income is adding up of business income 83,000, STCG which is not covered under 111A will be added to gross total income, so 20,000. Other short-term capital gains 10,000, interest on debentures 9,000. So total gross total income comes to 1,22,000. Out of this gross total income, we have to give deductions under 80D, medical insurance premium. On his own life, he is eligible for 3,000. He has paid premium of 3,000 and he is eligible for a maximum limit of 30,000. That is 25,000 plus 5,000, 30,000. So whichever is less, 3,000 is less. So entire 3,000 he can subtract. Under 80G or in the working notes, it's clearly given. Just pay your attention here. Under note 1 working notes, gross qualifying amount, net qualifying amount is given, rate of deduction and amount of deduction. National Trust for Welfare of Persons with Autism is 100% deductible. So your gross qualifying amount is 4,000, that becomes your net, and amount of deduction is 4,000. Donation to Gujarat government, fund set up by the Gujarat government is 100% deductible. So entire 3,000. Donation to Rajiv Gandhi Foundation is 50% and you have gross qualifying amount is 1,000. Out of that 1,000, only 50% means 500 is deductible. Donation to Prime Minister's Drought Relief Fund 5,000, out of which 50% is only eligible, so 2,500. And the last fifth one, donation to approved public charitable institutions. This will come under Group C with limit. That means you have to calculate adjusted gross total income. 10% of adjusted gross total income or your net qualifying amount 11,000, whichever is less, that we have to tick. Here to calculate adjusted gross total income, the formula is given. The actual gross total income is 1,22,000. out of which we have to give deductions under section C to section U. Or if you have any LTCG, that you have to subtract. If you have casual incomes, that has to be subtracted. So after subtracting all that, the gross total income, adjusted gross total income stands at 1,19,000. So 10% of 1,19,000 is 11,900, or rupees 11,000, whichever is less. So obviously less amount is 11,000. So that becomes your net qualifying amount. So out of this net qualifying amount 11,000, you are eligible for 50%. So 50% of 11,000, 5,500 you are eligible. Now you sum it up, all the 5 donations under 80G. Total it comes to 15,500. This 15,500 we have to show in the first format to calculate the taxable income under 80G. So now you subtract 15,500, 3,000 under 80D out of your gross total income. So your net total income comes to 1,03,500. There are long-term capital gains which we have not added in the gross. So now we will add it back. Net LTCG 4,10,000. So your total income is 5,13,500. Hope you have understood 80G. Pay a little more attention in learning this. Let us understand how to calculate adjusted gross total income for donations which comes under the C group with limit category. We have the gross total income of 5 heads of incomes. From this we have to subtract casual income, long-term capital gains and short-term capital gains with STT, and also deduct all the deductions from 80C to 80U except 80G and 80GG if you have in the question. Except these two, all other deductions has to be calculated, and finally we arrive at the adjusted GTI. The amount to be deducted under C group under 80G deductions, we have to take 10% of adjusted GTI or the actual amount of donation, whichever is less. From this less amount, first we have to deduct 100% eligible donations, and remaining on the balance, 50% of this balance will be claimed as deductions. So total, it's put together 100% eligible donation plus 50% of the balance. The total amount is nothing but the donation which has to be considered for C group. And when we calculate 80G deductions in total, that is total of A, B, C, 3 groups put together, then the total amount only is considered in the final format. To make you more conversant with 80G donations, I have shown you here the calculation of adjusted gross total income for group C donations. Out of gross total income, you subtract casual income, LTCG and STCG with STT. Then deductions from 80C to 80U except 80G. Then whatever amount you get is called as adjusted gross total income. Out of this adjusted gross total income, you have to take 10% of adjusted gross total income or the actual amount of donation, whichever is less. Out of this less amount, first you will subtract 100% eligible donations and then 50% eligible donations. Total put together 100 plus 50%, whatever the amount you get, is eligible for 80G donations under group C. This is how we have to calculate group C donations under 80G. Look at this question. Mr. Keshav furnishes the following income and expenditure relevant for the previous year, and we are supposed to calculate what is his total income. They have straight away given the business income, winning from lottery, donation to Prime Minister's National Relief Fund will be eligible for 100% deduction. Donation to Government of India for promotion of family planning will come under 80G Group C with limit 100%. Donation to Public Charitable Institute will come under 80G Group C 50% deductions. Let us solve this. Look at the answer. His business income is 95,500 and we have to add if there is any other income. It is clearly given only winning from lottery. Winning from lottery is nothing but casual income. So casual income we will not add it to gross. We will add at the end after giving the deductions. So your gross total income stands at 95,500. Out of this, deductions under 80G we have to calculate. Look at the working note 1. Prime Minister's National Relief Fund is eligible for 100% deductions. So 100% of 11,000 will be the qualifying amount. Donation to family planning will come under 80G C group donations 100%. And public charitable institutes will come under Group C 50% deductions. So there are two donations which will be eligible under Group C. Whenever we have Group C, you have to remember we have to calculate 10% of adjusted GTI. So to calculate adjusted GTI, we have to take gross total income minus deductions under section 80C to 80U plus casual income. So 95,500, we don't have any other deductions other than 80G, and we have to add casual income 4,500. Total it comes to 1 lakh. So 10% of 1 lakh, that is 10,000, or the actual amount that you have donated. You have donated 3,000 towards family planning. Look at the gross qualifying amount column. Family planning 3,000 and public charitable institution 12,000. So total it is 15,000. So 10% of 1 lakh, that is 10,000, or 15,000, whichever is less. So 10,000 is less. Out of this 10,000, first you have to subtract 100% eligible. 100% eligible is 3,000, that is family planning. So 100% you give, and in the amount of deduction column you can see 100% of 3,000 straight away we have taken. So out of 10,000 you have already subtracted 3,000. Out of 10,000, 3,000 towards family planning we have given the deductions. So how much is balancing? 7,000 is left. So this 7,000 will be shown under net qualifying amount column. Out of this 7,000, 50% only is eligible. So 50% of 7,000 is 3,500. Look at the last column, amount of deduction. So now by adding up all the three, total it comes to 17,500. This 17,500 we have to show in the first format, deduction under 80G. So now your total income becomes 78,000 plus if there are any casual incomes, LTCG, we have to add it back. So 4,500 winning from lottery is a casual, so that has to be added, and your total taxable income will be 82,500. Hope you have understood this 80G deduction donations. Look at this question. They have given us the information about gross salary, rent from house property, interest on bank deposits after deduction at source, means this interest will be the net interest. So whenever there is a net income, that has to be converted into gross, that you have to remember. And gross salary, rent from house property are not the actual taxable income. Still we have to apply some of the tax provisions of salary chapter, house property chapter. Agricultural income is there. That is another important adjustment in this question. We have to do the integration of agricultural income with non-agricultural income. long-term capital loss, short-term capital gains, interest on Kisan Vikas Patra gross is given, life insurance premium paid is given. Let us understand how to do the tax treatment for this. See, in this question, they have given us the gross salary. That gross has to be converted into net taxable income. So out of gross salary, you have to give deduction under section 16 if you remember, where it will be professional tax and standard deduction of 40,000. That 40,000 includes all other deductions that an assessee or an employee is eligible to claim. So 3,40,000 minus 40,000 standard deduction, 3 lakhs is your taxable income from salary. So we'll take it into the outer column. Rent from house property is given, which is nothing but your net annual value. You should remember your 5th semester income tax provisions. Out of this NAV, you have to give deduction under section 24. That means 30% of NAV as standard deduction. 30% of your NAV, 60,000, comes to 18,000. So after subtracting deductions, your taxable income from house property is 42,000. So take it into the outer column. Short-term capital gains, they have not mentioned whether it is STT or not. So we will take it to the outer column straight away, 24,000. Then we have long-term capital loss. It will not come here right now. We'll do that treatment later. Then under income from other sources, we have interest on bank deposits. It is given after deducting the tax absorbs, means TDS is already deducted, which means it is a net. So that net has to be grossed up by using the grossing up formula. So 10,800 divided by 100 minus TDS into 100. So you will get 12,000. Interest on Kisan Vikas Patra, it is given gross in the bracket. So entire 5,000 you show under income from other sources. So your gross total income is 3,83,000. Out of this you have to give deduction under 80C to 80U. You have insurance, life insurance premium 80C. So only 10,000 which you have paid towards life insurance premium out of his agricultural income, whatever it is, but life insurance premium 10,000 you can claim as deduction. So after that deduction, your total income becomes 3,73,000. To this total income, you have to add your casual income, LTCG, or any other STCG with STT if it is there. So casual income we have winning from horse races, which we have not added in the gross. So now we have to add it 20,000. And long-term capital loss will not be shown here because the loss has to be carried forward. It will be allowed to carry forward for 8 years, for future 8 years period. So only 20,000 will be adding it back. So your total taxable income stands at 3,93,000. Let us calculate the tax liability of the assessee. Tax on casual income will attract a flat rate of 30%. So 20,000 of horse race winnings at 30% comes to 6,000. Then tax on other income will be on slab rates. So here it comes the agricultural income integration. When we add agricultural income, what will be your tax? And when we don't add agricultural income to that limit, if we add the agricultural income to the ceiling limit, what will be the difference only we have to consider. So tax on other income, that is we have 3,73,000 before adding the casual income. So to that total income, we have to add agricultural income 20,000. It becomes 3,93,000 minus tax on agricultural income plus ceiling limit. Ceiling limit is up to 2,50,000. There is no tax for individuals. So that is called ceiling limit or exempted limit. So 2,50,000 plus 20,000, 2,70,000. The difference between the two is 1,23,000. So on this 1,23,000 only you are supposed to charge tax. Up to 2.5 lakhs there is no tax. So already we have integrated that with agricultural income. So remaining 1,23,000 you have to charge 5%. So 5% of 1,23,000 comes to 6,150. So your total tax liability becomes 12,150. You cannot claim rebate under section 87A because the assessor's income is more than 3.5 lakhs per annum. So on this tax liability you have to charge 4%. Education says 4% of 12,150, it becomes 486. So if you add that, it becomes the gross tax liability is 12,636. Already you have paid TDS on the casual income. Whenever you earn casual income like lotteries, gambling, betting, or winning from horse races, 30% will be deducted at the source. So that TDS, whatever you have already deducted, that has to be subtracted now. So 20,000, 30% becomes 6,000. You subtract. Your taxable tax liability, tax payable by the assessee is 6,636. Hope you people have understood the concept of taxable income and tax liability. And this is very important question for 14 marks. Look at this question. The assessee is running a cloth merchant business and the profit and loss account for the year ending 31st March 2019 is given. We are supposed to calculate what is her gross total income. Gross total income means total of 5 heads of incomes. So we should remember, while reading this question, identify each point, whether it comes under any of the 5 heads of incomes, whether it comes under any of the deductions from 80C to 80U. While reading the question itself, you make a point of it and it will help you while solving it. So I am not going to read the whole question in detail. Let us go to solve this. When the profit and loss account is given, it is understood that the solution we have to calculate, especially business income. So to calculate the business income, we have to apply the format under mercantile system of accounting. Net profit as per P&L account, add inadmissible expenses which are debited to P&L account. So those items which are debited to P&L account, which will be considered as inadmissible, we have to identify and then we have to add it back. So the first one is trade expenses. It is relating to business, so ignore. Establishment charges, rent, rates and taxes, all these are relating to business, so don't show in the solution. Household expenses. Household is relating to your personal, not allowed. It is inadmissible. So 1,850 you add it back to the net profit. Discount allowed is business expenditure. Income tax is inadmissible. Advertisements is admissible. Postage and telegrams is admissible. Gifts and presents relating to business, so ignore this. So gifts and presents has to be considered as inadmissible. Fire insurance premium, when nothing is mentioned, we will assume that this is relating to the business, so it is business expenditure. Donation to National Defense Fund, it is your out of personal interest, so it is inadmissible. Repairs is admissible expenditure. Life insurance premium is inadmissible. So all inadmissible expenses we have to add it back to the net profit. Advanced income tax paid. Income tax itself is inadmissible. So advance payment of income tax again becomes inadmissible. Interest on capital. This is capital invested by the proprietor. So any amount withdrawn by the proprietor for him or herself will be considered as inadmissible. Then audit fees is relating to the business, it is admissible expenditure. Now there are no other items to be added. If we look at the amount to be subtracted, non-business incomes which are credited to the P&L account. On credit side, we have dividends. Dividend from a domestic company is not relating to your business, so that has to be subtracted, which you have already added in the P&L account. Now you have to subtract. Interest on non-government securities is not relating to your business. Rent received from paying guest. So this is relating to your business expenditures. So only we have dividend and interest on non-government securities as non-business expenditures or non-business incomes, which has been added. Now we are subtracting. So your total income from business becomes 1,15,008 rupees. Let us calculate the gross total income. Gross total income means total of all 5 heads of incomes. We don't have income from salary is nil, income from house property is nil, profit and gains from business and profession is 1,15,008 rupees. Capital gains we don't have. Income from other sources. Under income from other sources, we have dividend, which is from Indian company, so it is exempted, nil. And interest on non-government securities, net amount is given. So whenever there is net, that has to be grossed up. So we have used grossing up formula 1592 into 100 divided by 100 minus TDS. TDS will be normally 10%. So we have calculated the gross as 1769. So by adding all these 5 heads of incomes, your gross total income is 1,16,777. This is how the calculation of gross total income we have to do. Suppose if they ask, find out the net income or total taxable income, then we have to do the further calculation from gross total income. That is, deductions we have to give. The very important deductions which we can identify here is donation to National Defence Fund will come under 80G, 100% deductible. So that 800 rupees we can show as deduction, and we can simply calculate what is the total taxable income and tax liability. Look at this question. Mrs. Sunita submits the following incomes and expenses. So out of this income and expenses information, we have to find out what is her taxable income and tax liability. So let us do that. Okay, look at the solution. Taxable income from salary 2 lakhs. Computed income from house property 65,000. Whenever they have given computed or taxable value, you can straight away take that amount into the amount column. If they give gross salary or rent received from house property, which means that you have to do the further calculations. Then agricultural income from Bangladesh. Agricultural income within India is exempted from tax, whereas if you receive agricultural income from outside India, it becomes taxable. And it is taxable under income from other sources, so 1 lakh rupees. Then share of income from HUF is exempted. Computed income from short-term capital gains is given, so that becomes taxable. So by adding all this, it becomes the total gross total income 4,40,000, out of which you have to claim for deductions. Under the expenses, it is given life insurance premium is paid 28,000 and the sum assured is 25 lakhs. So normally we take the premium 28,000. Then medical insurance premium under 80D deductions, you can claim 18,000 or 30,000, whichever is less. Loan repayment towards home loan installment under 80EE, you can claim 20,000. Contribution towards Swachh Bharat Kosh under 80G donations, 100% it is eligible for deductions. So 20,000. So after deducting the total deductions, your total income stands at 3,54,000. And look at the tax liability calculation. Out of this 3,54,000, up to rupees 2,50,000 there is no tax. So if you subtract 2,50,000 from 3,54,000, the difference amount is 1,04,000. On this 5% becomes tax liability. So that becomes 5,200. On this 5,200, you can't claim rebate of 2,500 because your total income is more than 3.5 lakhs. So you can straight away add education cess at 4%. 4% of 5,200, 208 rupees. So your total tax liability stands at 5,408. Hope you have understood these concepts.